A U.S. crash is coming. I'm your host, Steve Van Metre, and thanks for joining me today. And while investors remain bullish on stocks, the U.S. economy is on the brink of crashing. And the catalyst, you're wondering? Well, it's none other than the dollar. Let's over to Bloomberg, where we picked today's story up as investors grow more bullish on dollar, even as the index cracks records. The index, which tracks the performance of 10 global currencies versus the U.S. dollar, has gained almost 12% so far this year amid concerns over a global economic slowdown and rising interest rates in the U.S. The spectacular surge has also been fueled by a weakening Chinese yuan and a plummeting euro. The common currency has been pushed to a 20-year low against the dollar after Russia's decision last week to indefinitely shut down natural gas flows to Europe through the key Nord Stream pipeline. But is this really a story of other currencies weakening against the dollar, or is it really a story of a dollar shortage? Let's continue on, because the dollar pain spreads from emerging to developed economies as we continue here, fueled by the Federal Reserve's most aggressive tightening cycle. And this is a key point that I want you to understand, that the world here believes that central bankers are in control of their currencies. The Fed, when it tightens, causes the dollar to go up. But that's really not that true. In a closed system, that is true. But when you're the global reserve currency, well, the Fed has a lot less control than they think. But that doesn't stop what people believe. The stronger greenback is pushing rival currencies lower, driving up the cost of imported goods, constricting financial conditions, and feeding inflation in other economies. And there's a lot of truth to that. Because when the dollar goes up, let's look at import prices coming into the U.S. What we should see is that if prices in other countries are going up, that means prices coming into the U.S. should be going down. And what do we know? Here we see the dollar in red when it shoots higher. Import prices come crashing down. Dollar goes up, import prices start to move down. Dollar rises, import prices fall. Dollar's rallying here, import prices are still going up. And what do we note the reason for that? Well, it's a pandemic, but what are we starting to see signs is import prices are starting to come down. And when they do, they can come down really fast. Let's continue on, because now the question then is, will this actually alleviate inflation? Can the stronger dollar do that? Well, yes, because when you look at inflation, now we have the consumer price index in the year-over-year rate of change shown in red against import prices. And what you'll notice is that even though import prices are not on a year-over-year rate of change, what we can see is consumer prices are a function of two key things. They are a function of gas prices and import prices. So when you see import prices start to fall, that means inflation is coming down. That's ratcheting up pressure on other central banks to raise interest rates, just as an energy crisis and spiraling consumer prices hobble Europe's economies and increases in borrowing costs to cool housing markets in Australia, Canada, and New Zealand. Yet their ability to influence the dollar's strength is limited, meaning there's little prospect for near-term relief. And there's truth to that as well, because what you see is the belief is if the Fed can raise the strength of the dollar, that means other central banks need to tighten as well. So where the Fed goes, everyone else follows, but not quite everyone, which we'll get to in a bit. A stronger dollar generally comes with higher short and long-term interest rates in the U.S., or with stress in the global markets and a flight to the dollar's perceived safety. Those tighter financial conditions cause developed economies everywhere to slow, which we're seeing. But the question we should be asking is, why do we see the dollar and interest rates rise? And does that mean interest rates are going to continue to go up? Well, now let's look at the dollar shown in red against 30-year treasury yields in blue. And what we note is they don't run together that often, but when they do, and here's some points that I circled, you can see yields rising, the dollar's rising. Here you can see dollars rising, yields turn higher. There's another point right in here that I didn't mark. Here you can see dollar going up, yields rising. And again, we're seeing that now. And what does that tell you is actually going on here? Well, it means there's a dollar shortage. And what happens after this, and I want you to be thinking, is where are dollars created? Because what happens next? Well, you'll note after these period of strength, yields come crashing down each and every time. And even though the consensus view our yields must go higher, yields are more likely to come down. And you'll see why here in a bit. But the dollar's bad news for the U.S. economy. And here we note that we have the dollar shown in blue against the Wilshire 5000 on the right, shown in red on a year-over-year rate of change. And you can see as the dollar trends higher, the stock market starts to flatten out its returns. Dollar goes up, market starts to flatten out. We can see perhaps the reason the market is going down right now is due to the dollar strength. And the question you should be asking is, why is that? Because the simple answer is domestic producers, manufacturers cannot compete with cheaper foreign goods. So right now you have stores and warehouses all full with goods that were bought at higher prices. And what is starting to flow into the country now due to the stronger dollar? Cheaper goods that are going to undercut the price of the goods that we already bought. That means wholesalers, retailers are going to have to discount even more, and that's going to lead to lower profits and in turn, weaker stock prices. Let's continue on, because where is this all going? Why do we see this dollar shortage here? And how do we know? Well, it's simple. It's the story of musical chairs. And in a dollar denominated world, the chairs in musical chairs are dollars. And we know there's a finite number of dollars relative to the amount of debt. There's always a dollar shortage. Now, even though there are more dollars outside the U.S., what I want you to understand, the people circling those chairs, those are borrowers, people who have borrowed in dollars. And what do they need to pay their loans? They need dollars. And what the problem is, the music, well, that's the day that their loan is due. The next payment is due. And so what happens during a dollar shortage, the music plays until the payments are due. And then what happens is there's not enough chairs for everyone to get by. And that's why we see things blow up. So the question now I'll ask you is, where is money created? Where does money come from? And if you think it's the Fed, well, it's not. It's actually, well, hang on a second, because it's not the Fed. What is it? That's right. It's commercial banks. Banks are the ones who originate loans. And so that's why you see rates having to fall, because how do you get people to borrow money? It's when rates go down, they tend to borrow more. And what is the Fed doing right now by raising rates? Well, they're constricting lending demand by driving rates higher. And now you can see how this whole thing comes tumbling down. And just by raising policy rates, other countries are unlikely to stop the depreciation of their currencies. That's because dollar strength not only reflects an expectation about the federal funds rate hikes this year and thus higher demand for U.S. fixed income assets, but also reflects global recessionary risk arising from the greater than previously expected policy rate hikes around the world. And if you're concerned what all of these hikes could do to your portfolio when the Fed ultimately causes the next recession, well, you shouldn't be. I'll put a link up here to Portfolio Shield and the description below. Let's continue on. Because we know the Fed is on the verge of crashing things. We can see that when the Fed raises the funds rate shown in blue, the stock market shown in red eventually breaks and heads down. The faster the Fed hikes, the more likely things break. And now the Fed is embarking on one of its fastest hiking cycles ever. And how do we know? Well, we know they're likely to hike here in a couple weeks because this article from the Wall Street Journal by Fed whisperer Nick Timmerow says Jerome Powell's inflation fighting pledge could tee up another 75-point interest rate hike by the Fed. So you can almost now count on the fact that the Fed is going to at least do 50 basis points, maybe even 75 later this month. And what does that mean for other central bankers who believe the dollar's got to go higher? They have to keep tightening. We keep tightening and tightening and tightening until something breaks. But don't worry, this will be spun as good news, and you'll see headlines like this: as the U.S. dollar strength lifts Americans' relative spending power. And an index that considers inflation when measuring the dollar strength relative to currencies of major U.S. trading partners in July topped its previous peak from 2002, showing how dollar surge has helped mitigate rising domestic prices. Well, not yet, but it will. The real effective exchange rate for the dollar, calculated by the Bank for International Settlements, measure the currency against a group of key U.S. trade partners, taking into account changing prices of goods and services in each relevant economy. And some say inflation provides a broader assessment of a currency's relative purchasing power than traditional measures. But what's the key point here is, why is the dollar so important to what we're doing, and why is it going to blow things up? Because there's a global shortage, and the shortage is outside the U.S. So the stronger the dollar goes and higher, well, the more likely something snaps and breaks. And when we talk about money being created by the banks, how is money destroyed? Well, when you pay off a loan or if you default. The rest of the world gets a double whammy of higher import prices and tighter liquidity conditions. The benefits to the U.S. are probably less damage to the rest of the world, but there's not much can be done. No, the damage is coming to the U.S. because higher dollar, well, that means higher unemployment as U.S. workers find that they can't compete with cheaper foreign imports. But what we note is that there's two countries that are going to self-implode on their own beans because China sits yuan fix at the strongest bias on record as losses mount, as the People's Bank of China set to fix at 454 pips, stronger than the average estimate in Bloomberg's survey. The move marks the 11th straight day of stronger than expected fixings by the PBOC and follows a reduction in foreign currency reserve requirements for financial institutions announced on Monday. The Chinese authorities are leaving no doubt about their resolve in dampening the depreciation pressure on the yuan. What is clear that the authorities are not seeking to defend any particular level, at least not yet, and the fixings are still being set weaker in the face of dollar strength. And why are they doing that? It's simple, because they're easing, and that's causing their currency, the yuan, to fall in value. And when it does, what do people do that have yuan? What do they want to do? That's right, get their money out and go buy dollars or something else that's either rising or at least holding its value. And who else is making this mistake, you ask? Well, there's another country. That's Japan. The yen plunge worsens despite strongest government warnings yet, as we see Japan's currency has slumped 20% this year and fell past its previous worst annual drawdown in 1979. The new sell-off in Treasury this month has widened the yield gap between the U.S. and Japan, driving up the dollar and pushing the yen to a 24-year low. But the bond market on Wednesday, the BOJ said it would boost scheduled debt purchases as the intensifying Treasury sell-off also put upward pressure on yield. The move came as Japan's benchmark 10-year yield approached the 0.25% upper limit of its tolerated trading band. So you have multiple factors here. You have the fact that you have China and Japan easing and their currencies getting obliterated. You also have the fact that in order to get dollars, all of these people outside of the U.S. have to sell their dollar reserves, and they hold their dollars in treasuries. Inside the U.S., how do people hold their savings? In their savings account. Outside of the U.S., it's done with treasuries. But before we wrap up, let's head over to our chief strategist, Jeff Snyder, with another ominous prediction from himself on the non-manufacturing PMIs that we talked about in yesterday's show. We noted that the S&P Global was headed into a contraction based on the services sector, while the ISM was headed higher. He says the two PMIs ostensibly measuring the same sector of the same economy, yet two completely different results. This is actually nothing new, he says. During periods of a downturn, even recession, the ISM services index is consistently higher, if not also moving higher compared to the S&P, notably former the IHS market. And he notes at the end of his daily, the ISM non-manufacturing is by no means a stronger number. In fact, it hasn't peaked yet, or perhaps it's picked up the same accelerating downside that is yet to come. To get more on Jeff's research, of course, our energy and materials specialist, Tracy Schuchart, and my Momentum Timer Pro report, click on marketsinsiderpro.com. Sign up. It's still free for a limited time. But now you understand that the stronger dollar, it's bad news for the U.S. economy, and it's bad news for the rest of the world. And there's only one resolution. Rates have to come down and new dollars have to be created. But when you start to see the bigger picture is import prices fall relative to the U.S. And why is that key? Because where do dollars flow if people are buying cheaper foreign imported goods? They flow outside the U.S. into the part of the world that is in desperate need of dollars. But at the same time, because the dollar is too strong, it leads to rising unemployment in the U.S. and a recession. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.